Hey everyone, you've probably noticed by now that your first test is up and it's an Excel template for you to fill out. It might look a little different than what you've been doing in my accounting lab, and I wanted to give you something to use as reference, so I took one of the alternate versions of the test and we're going to work through this together. I am doing this live, I'm not going to edit this down, so if I misspeak at some point I preemptively apologize. Let's get started. So Alpha Corporation is going to be our company, and they manufacture widgets and sell them to wholesalers. This is their first year of operations, which means at the beginning of the period all the balances of their accounts are zero because they're brand new. Since they're brand new, the first thing they're going to do is they are going to issue shares, their IPO, their first offering to the public. In this case, they are issuing 50,000 shares at $1 par common stock for $12 a share. So let's start filling in the journal entry on how Alpha Corporation will book this. The first thing that we do is we click in the date cell and we put in the date. It's January 2nd. If we just type 1-2, Excel will know to change it to January 2nd, and that's fine. The reason that Alpha Corporation is making this initial public offering is because they want to raise cash. So our debit is going to be to cash. How much cash are we receiving? Well, we're receiving cash equal to the number of shares we're issuing times the issue price. So if you go into the cell for our debit over here and we type equals the number of shares being issued, which is 50,000, times the issue price of $12 per share, we see that Alpha Corporation, once we hit enter, is going to have $600,000 in cash coming in. Because they're issuing above par, they're going to need two credits, one to the par portion of the stock issuance and one to the portion that is in excess of par. So let's start with the par portion. We're going to credit it to common stock. For your credits, just hit the space bar 3, 4, 5 times, just enough to indent so it's easier to read entries. This is going to go to common stock. So in the credit reference over here, we're going to hit equals the number of shares issued, 50,000. This is the portion that goes towards par, so we're going to multiply it by a par price. Equals 50,000 times 1 is 50,000. Easy enough. Our second credit is going to be to our paid in capital in excess of par account, which is a whole lot to write. So most people, including myself, will abbreviate it to PIC and usually denote what type of stock it is afterwards, so PIC-common. If you want to write paid in capital in excess of par, that's totally fine. I'm just lazy and I like writing in shorthand, so I'm going to go with PIC-common. How much is going in excess of par? Well, what we're going to do is we're going to take the number of shares issued, still 50,000, and we're going to multiply it by the difference between the issuance price and the par price, $12 and $1. Throw those up in parentheses. So we have equals 50,000 times 12 minus 1, giving us a total of 550,000, which is a good thing because now our debits equal our credits. We have 600,000 on both sides. The last thing we need to do is we need to make a quick description of what happened during this transaction. What we did is we issued common stock. I'm not sure how many of your professors required you to put a description into your journal entries. I would much prefer that you did, and I will tell you why. I once got contracted to fix the books for a not-for-profit agency. The person who was keeping books before me did not really know what they were doing. And I went in and it was just a straight up hot mess. The worst part of it was there was no descriptions anywhere. So I didn't know what the intent of the transaction was. If there was, an entry that was a debit to cash and a credit to rent expense, well, it doesn't make much sense, and I'm assuming that it's upside down because that's the way a normal entry for rent would be, and that entry was actually in the books. Problem is there's no intent to it. I don't know what happened. If it said paid rent in the description, I would have known right then and there that the person before me just flipped the debits and the credits. Since it was there, I couldn't assume. I had to go through and recreate their entire books for the year from the listings in their bank account. It took me like 3 days. You're probably going to be working at a place where there's several accountants looking at one set of books. It helps immensely if there are descriptions in the journal entries so people know exactly what happened. That being said, we get to move on to the next entry, which is occurring on January 3rd. So what's happening on January 3rd here? Well, Alpha is issuing 5,000 shares, this time of its $50 par 6% preferred stock, but they're issuing them for $60 per share. So again, this is above par. We're going to need a PIC account. They are still doing this to receive cash, so we're going to debit cash, and we're going to debit cash for the amount of preferred shares being issued times the issue price, which in this case is $60. So we have a debit to cash for $300,000. Let's keep our debits and credits in order. We'll put the first credit to preferred stock, and for the amount we credit to preferred stock, it's the only amount that can be attributed to par. So we take the amount of shares being issued, which is 5,000, and we multiply it by, this time, the par price, which is $50. It's going to give us 250,000. So for our debits to equal our credits, we need a credit that recognizes the amount of money, that investors paid above the par price of this stock. Well, how much was that? We can figure it out. We'll go to this credit cell reference over here with equals, and we take the number of shares being issued, which is 5,000, and multiply it by the difference between the issue price of $60 and the par price of $50. That's going to come out to be 50,000. Take a quick check, and we see that our debits do equal our credits, so our journal entry is good. Our description is going to be that we issued preferred stock. Next entry on January 4th. Scroll down here so it's up at the top. Alpha Corporation is issuing $100,000 of its 3% 5-year bonds, and they're issuing them at a bond price of 102. These bonds are going to pay interest semi-annually. Start with our date like we always do. This is happening on January 4th. The reason we are issuing bonds, again, is to raise cash. Well, how much are we issuing in bonds? We're issuing $100,000 worth of face value of bonds, but we're not issuing them at face value. We're issuing them at a bond price of 102, and since the bond price is greater than 100, we're issuing them at a premium. We're charging more than face value for the bonds. How much are we charging? Well, you can figure that out by taking the face value of the bonds, which is 100,000, and multiplying it by what percent of face value our bond buyers are going to pay. Since it's issued at a bond price of 102, they're paying 102%, which we can express in decimal form as 1.02. Means that Alpha Corporation is going to get $102,000 for these bonds. We're going to again need two credits. The first one is going to be to bonds payable, and this is always for the face value of the bond, and the face value of these bonds being issued is $100,000. The bonds have $100,000 face value, but we're actually getting paid $102,000, which means we're asking our investors, people buying our bonds, to pay a premium. So we have another credit to premium on bonds payable, and that number is always the difference between the amount of cash coming in. So you can click equals and then the cell that represents the amount of cash minus the face value of the bonds, and we can click the cell that represents the face value of the bonds. 102,000 minus 100,000 is 2,000. That is the amount of premium that we are charging on these bonds, and our description is that we issued bonds at a premium. Next up, we have January 5th. And on January 5th, Alpha is signing a $60,000 4% 3-year notes payable. Entry is quite simple. We are signing this note payable, this loan, to receive cash, so we are going to debit cash for how much money we're borrowing, because our amount of cash is going to go up. And in our credit, we're going to recognize the liability that we have from signing this note. So we're going to credit notes payable, and again, that is going to be for the value of the note. We signed a note, so we're going to put that in as our description. On June 15th, Alpha Corporation is declaring a 50-cent per share dividend to its common shareholders and a normal semi-annual dividend to its preferred shareholders. Start with the date. 6/15 is June 15th. In this case, our debit, whenever you pay dividends, is going to be to an account called cash dividends. It is like a withdrawing account because you're withdrawing money from your company to give it to your shareholders. We'll type in the name of the account, but we're going to leave that number blank for right now. Why are we doing that? Because we need to figure out how much we owe to common shareholders and how much we owe to preferred shareholders individually before we can figure out the total amount of dividends that we are paying. So our first credit is going to be to dividends payable common. To figure this out, we figure out the number of shares that are outstanding, and we multiply that by our dividend rate on common shares. Well, let's figure out how many shares we have outstanding. We can scroll back up through our entries. And as we see in our very first entry, we issued 50,000 shares. We've not bought back any of those shares, so all 50,000 of those shares are still in the hands of our shareholders. Therefore, they are all outstanding. We owe dividends on the entire 50,000 shares. So here, we can figure out how much we owe in total by taking the number of shares we have to pay dividends on, which is 50,000, and multiplying it by the dividend rate. And our dividend rate is 50 cents per share, which means we owe $25,000 to our common shareholders. We also owe dividends to our preferred shareholders. So we're going to have a second credit, and this one is going to be to dividends payable preferred. This is a little more tricky to find out. What we're going to do is we're going to start by figuring out how many shares of preferred stock do we have to pay dividends on. Well, we can scroll up and see that we have 5,000 shares outstanding to our shareholders from our January 3rd transaction. That's when we issued 5,000. We haven't bought any back. We owe dividends on all 5,000 of those shares. For preferred stock, you find the amount of time, the amount of money that you have to pay by taking the standard formula, which is the number of shares that you have to pay stock on, in this case 5,000, multiplying that by the par value of that stock, which is we went back and saw in January 3rd was $50, and multiplying it by the rate that we pay dividends on this preferred stock. So scrolling up here, and our preferred stock pays dividends right here at a rate of 6%. So we're going to come down here, and we are going to multiply that by 0.06. That is how much dividends we owe to our preferred shareholders during the year, but we're not paying for a full year's worth of dividends. As you can see right here, it says semi-annual. So to figure out the semi-annual amount of dividends, well, semi-annual means every 6 months, every half a year. We're just going to divide that number by 2. And when we do that, we're going to come up with $7,500. So we owe $2,500 to our common shareholders. We owe $7,500 to our preferred shareholders. The amount of cash dividends that we need to debit is equal to the total amount of dividends we're paying. So if you add that $25,000 and that $7,500 together, we're going to have to pay out $32,500 worth of dividends. But we're not actually paying them yet. We're just saying that in the future we're going to pay dividends. This is our declaration date. That's why we made liabilities. So we're going to state in our description that we declared dividends. Down here on July 2nd, we're going to actually pay those dividends. So the journal entry for this, you fill in the date, it is July 2nd. And all it is essentially a flip of the last entry. It's taking your payables off of your books and denoting that you paid out an amount of cash to pay off those payables. So our first debit is going to be to dividends payable common. If I could type, this would be much easier. There we go. Dividends payable common. How much are we paying in dividends payable to our common shareholders? That $25,000 that was listed above up here. Our second debit is going to be to dividends payable preferred, and that amount was $7,500. So to pay off these liabilities when we declare dividends on June 15th, we are going to have to send out cash to our shareholders, and our shareholders in total are getting $32,500 worth of cash, same thing that we put into cash dividends above. So what happened here is we paid dividends. Next entry, July 4th on 7/4, we are making a semi-annual interest payment on our bonds payable. The discount, or in this case premium, on these bonds is going to be amortized using the straight line method. So whenever you make an interest payment on your bonds, you're going to start with a debit to interest expense to recognize the amount of expense you're going to pay. Just like we did before, we know that's going to be our debit, but let's leave that blank for right now because we're not sure how much we're going to have to put in there. Our second debit is going to be the premium on bonds payable. We're using the straight line right here method of amortization, which means we're going to take away an equal portion of our premium each time we pay interest over the bond's life. So let's go back up and find the journal entry for our bonds, and as we see right here, they are 5-year bonds that pay interest semi-annually. So if it's a 5-year bond that pays twice a year, that means there's going to be 10 payments in total, 5 times 2. Well, that $2,000 premium we had, we have to distribute evenly over those 10 payments. So the easiest way to figure out how much you are amortizing your premium for is to take the original amount of the premium, which was $2,000, and divide it by the total number of payments that you're going to make, which in this case is 10. And under our straight line amortization method, we are going to amortize that premium by $200 each time that we pay it. The payment of interest requires a credit to cash because our cash is decreasing, and cash as an asset decreases on the credit side, so we're going to credit cash. How much are we going to credit cash for? Well, to figure that out, we're going to use the same standard interest formula we had, principal times rate times time. So let's go back up to our bonds here. Our bonds have a face value. Every time interest is paid, it's not paid on the amount of cash you received for issuing a premium or discount. It's calculated using face value. So we have $100,000 worth of bonds. Those bonds pay interest at 3%, and they pay interest semi-annually. So when we go back down to our journal entry for payment, what we're going to do to figure out that formula is we are going to take the face value of the bond, which is $100,000. We are going to multiply that by the rate of interest on those bonds, which was 3%. And because we are paying a semi-annual interest payment, we are paying it for half the year, or 6 out of 12 months. So we multiply it by 6/12. And yes, before someone asks, you can also just divide by 2 right there. It's also fine. So when we hit enter, we're going to come up with $1,500. That's the amount of cash interest that we are paying to our bond holders. So now we need to figure out what we need to debit interest expense for to make our debits equal our credits. Well, easy enough. If we are paying out $1,500 in cash, and these bonds have a $200 amortization on the premium, the difference between those two numbers is $1,300. That is the amount we are going to debit our interest expense account for. And to record what is happening in this transaction right here, what we're going to do is we are going to say that we paid interest on bonds. Next entry we have is on July 5th, so we're going to go to 7/5. We are making a semi-annual payment of $10,000 plus 4% interest on our notes payable. Well, the $10,000 is the amount that goes towards principal, and since we're paying it off, we're no longer going to owe it, which means we need to decrease our liability, our notes payable. Liabilities, as always, are going to increase on the credit side and decrease on the debit side. Since we're decreasing the amount that we owe on this note, we are going to debit notes payable for the amount of our payment that goes towards principal. And the amount of our payment that goes towards principal right here is $10,000. It's our first debit in this transaction. Our second debit is going to be towards interest expense. And again, we're going to use the same formula we had here, principal times rate times time. So let's go back up and find the signing of this note. So this note is a $60,000 note. It has 4% interest, and it's a 3-year note. When we come back down here for our interest expense, what we're going to do is we are going to take that $60,000 that we owed, we're going to multiply it by 0.04, the rate of interest, and we're going to multiply that by 6/12. And we're going to come up with $1,200. That is the amount of interest that we have to pay on this note at the time that we're making a payment. So, in total, if we are paying $10,000 towards notes, towards principal, and $1,200 towards interest, we have to give this lending institution, probably a bank that we took this note out with, an amount equal to the sum of those two numbers. So you just click equals, click the amount that goes towards principal plus the amount that goes towards interest, and you come up with $11,200. What happened here is we made a payment on note, and my cuckoo clock's going off in the background. I apologize. Let's wait for that to stop for a second. Okay, now that's over with. We can move on to the next entry. We have August 1st. And on August 1st, we purchased 40,000 shares of Beta Corporation's common stock for 75 cents per share. We're investing here. We're buying into another corporation in the hopes that the value of the corporation we're investing in has their stock price appreciate or go up. Plus, maybe we'll get some dividends. But we have free cash, and we want to buy into another company in order to maximize the amount of profit we can have. So, we're buying stock of another company. The stock of another company is referred to as equity, and since we're buying into another company, we are investing in that company. So our debit goes to equity investments. How much are we going to debit equity investments for? We're going to debit equity investments for an amount that is equal to the number of shares that we are purchasing times the price that we are paying per share. So in our cell for our debit, we are going to take the amount of shares we're purchasing, which is 40,000, multiply it by that 75 cents per share that we are paying, and we're going to come up with a total of 30,000. What do you have to give a company to buy stock from them? You have to give them cash. So our credit is going to be the cash for that same amount, that same 30,000. What we did here is we purchased shares as an investment. On to August 2nd. On August 2nd, Alpha Corporation, which is our company, is repurchasing 12,000 shares of previously issued common stock. So we issued the stock before, and we've decided now that we are going to buy that stock back from our shareholders and put it into our treasury. So this is a treasury stock transaction. Anytime that you're buying back your own stock, you don't put it as an investment, you always list it as treasury stock. So on August 2nd, we are going to have a debit to treasury stock, and typically you denote what type of stock you are buying back. In this case, it is our common stock, as you can see over here. So it's a debit to treasury stock common. To figure out how much treasury stock we're buying back, we're going to multiply the number of shares we're purchasing times the price that we're paying to rebuy those shares. So in the cell, we hit equals 12,000 times that $13 per share. Means that we're buying back $156,000 worth of our own stock and going into treasury stock. And how are we buying it? We're buying it by sending out cash. So cash is going to get credited for that same 156 grand. In our description, what did we do? We purchased treasury stock. The next journal entry happens on August 3rd. So on 8/3, Alpha Corporation is purchasing $25,000 worth of 10% 10-year bonds from Omega Corporation. Alpha plans to hold these bonds until maturity. Again, these aren't our bonds that we're buying back. We're buying another company's bonds. So we are investing in those bonds. Our debit is going to be to an account to recognize that investment. We're holding these bonds till maturity, and bonds are debt for the company that's issuing them, so the account that it goes to is held to maturity debt investment. And for abbreviations, you can just write HTM. So we have our HTM, debt investment. What is the amount that we are paying to buy these bonds? It says right in the description of what happened, 25,000. So we're going to debit HTM debt investment for 25,000, and we are going to credit cash for that same amount, that same 25 grand. In our description, we are going to let the other accountants that we work with know that when we put this in, we put it in because we purchased bonds as an investment. Next up, we have October 1st. Let me scroll down a little bit here. On October 1st, Alpha Corporation received a 5-cent per share dividend on the common shares of Beta Corporation. That's the company that we invested in just a couple entries ago. So on the date, it is October 1st. And we are going to start by debiting cash, because in this case we are the ones receiving the dividends. So if we're receiving the dividends, our cash is going to go up. Cash is an asset, increases with a debit. We need to figure out how much cash we're getting. Well, we need two things to figure that out. We need to know how many shares we own, and we need to know what the rate of dividend is per share. Well, the second part is easy. It says right here we're getting 5 cents per share for dividends. Well, how many shares do we own? Let's scroll up for a second. And in our August 1st transaction, when we see where we bought this stock, we bought 40,000 shares. We haven't sold any of it, so we still own all 40,000. So to figure out how much cash we're receiving, we take those 40,000 shares, we multiply it by 5 cents, and we come up with big bad $2,000. That is how much cash we are receiving. This is money that is coming in to our business from a fairly typical course of action. Companies always invest in other companies. Whenever you have money coming in that's from something that's typical of your business, it's recorded as a revenue. In this case, this revenue is being caused by dividends, so we are going to credit dividend revenue for that same 2,000. What happened here is we received a dividend. Next journal entry brings us to October 2nd, and Alpha Corporation, us in this case, is receiving a quarterly interest payment from Omega Company for the bonds that we purchased from them earlier. Well, to figure out what's going to happen here, start by filling in the date. This is another one of our investments. So this interest coming in is not an expense to us. It is revenue coming in, which means we are going to receive cash. How much cash are we going to receive? We're going to receive cash based on the standard formula for interest. So we need to go up and find the journal entry where we purchased these bonds, which is only two above. On August 3rd, we purchased $25,000 worth of 10% 10-year bonds from Omega. So to figure out how much cash you're receiving, what we're going to do is we're going to multiply the face value of those bonds, which is 25,000, times the rate of interest that those bonds pay, which is 10, and then times time. In this case, we have, as you can see right here, a quarterly interest payment. That's 1/4 of the year, 1/4 of the year. Well, if there's 12 months in the year, that means that every quarter of the year is 3 months. So we multiply that by 3/12. We figure out that Alpha is receiving $625 in cash from Omega for the bonds that we purchased earlier. Again, this is fairly typical. It's going to get recorded in a revenue account. In this case, it's not technically a dividend because dividends are exclusive to stocks. This is interest from a bond. So we are going to credit interest revenue for that same $625. Description here says that we received an interest payment. Next up, on November 1st, Alpha Corporation is going to sell some of the stock that they purchased from Beta Corporation. Start with the date, 11/1. Whenever you sell stock, what are you going to receive? You're going to receive cash because you wouldn't be selling it if you weren't getting anything. How much cash are we going to receive? It's simple enough. You just simply take the number of shares that you are selling, in this case 20,000, and multiply it by the amount that you're selling each share for, which is $2. So we have $40,000 in cash. We're going to need 2 credits here, and the first credit is going to be to an account that we already used called equity investments. Whenever you sell an equity investment, when you take it off the books, you don't take it off at the price that you are selling the stock for. You take it off at the price that you purchased that stock for. So let's go back up and see how much we paid to buy shares of Beta Corporation. And up here in our August 1st entry, we see that we paid 75 cents per share right there. So we can scroll back down, which means that the 20,000 shares that we're selling right now were purchased at 75 cents a piece. So if you multiply 20,000 times 0.75, Alpha Corporation, despite the fact that they're making $40,000 on the sale, only paid $15,000 for that stock in the first place. Our debits don't equal our credits, so we're going to need another credit here, and that credit is going to recognize the fact that we are selling this stock above the price that we paid for it, and that is called a gain on investment sale. I've also seen it called gain on sale of investments. I've seen it as gain on disposition of equity investment. Whatever name you want to use, I don't much care, as long as you tell me that it is a gain or maybe a loss, and what you did to have that gain. So gain on investment sale is perfectly fine. We paid $15,000 for Beta Corporation's common stock. We're selling it for $40,000, which means the amount of profit that we made, which is our gain, is the difference between those two numbers, and that's going to come out to be $25,000. In our description, we're going to say what happened. We sold Beta shares. Fine with me. We're down to December 1st, which is us selling treasury stock. So we repurchased the stock above our own stock. Now we're selling that stock that we repurchased back to our potential investors. So let's start with the date, and the date is on 12/1. And here we're going to start with a debit to cash. We're selling treasury stock. How much cash are we receiving? We're receiving cash equal to the number of shares that we're selling, which is 10,000, times the price that we're selling those shares for, $15, which means we're going to receive $150,000 in cash. We're going to need a credit to treasury stock common to take that treasury stock off our books, since it's no longer in our treasury. And just like we did with equity investments, we don't take treasury stock off the books at the price we're selling it for. We take it off the books at the price that we paid for. So we need to go back up in our journal entries and figure out how much we paid for each one of those shares when we repurchased this treasury stock. And as we see up here in our August 2nd entry, when we bought those shares back, we paid $13 per share. So to figure out how much treasury stock we have to take off our books, we multiply the number of shares we're selling, 10,000, times that $13. Our debits don't equal our credits. Well, what are we going to need here? We're going to need an account to recognize the difference, and that account is called PIC Treasury. PIC Treasury is going to be credited for the amount of profit, if you will, that we made on this resale of our treasury stock. So if we paid $130,000 for it, and we're receiving $150,000 when we sell it, the amount of profit we have is the difference between those two numbers, which is $20,000. And in our description, we say that we sold treasury stock. Next entry, on December 15th, we've got Alpha Corporation declaring dividends. Again, this time it is a 50-cent per share dividend on common and our normal semi-annual dividend on preferred. So we start with the date, which is 12/15. Just like our entry above, whenever you declare dividends, you're going to debit your cash dividends account for an amount that is equal to how much you owe to common shareholders plus how much you owe to preferred shareholders. Well, we don't know that yet, so let's leave it blank and move on to our two credits, which is dividends payable common and eventually dividends payable preferred, but we're going to start with common stock. The formula to figure this out is the number of shares that are outstanding times the rate of dividends that we are paying. So we need to figure out how many shares are outstanding, which becomes difficult when you have treasury stock coming in and going out. Well, we need to figure out how we're going to get there. So we're going to have to trace how our common stock moved, which requires, unfortunately, I apologize to you guys, a lot of scrolling. We're going to have to go back up. On January 2nd, we issued 50,000 shares of treasury stock. At that point, we had 50,000 shares outstanding. And that amount that's outstanding is only going to get changed when we purchase or sell treasury stock. So let's scroll down and find our treasury stock transactions. And on August 2nd, we have the repurchase of treasury stock. So on August 2nd, we purchased 12,000 of those shares back. We issued 50,000 to start with. We bought 12,000 back, which means on August 2nd, there was 38,000 shares outstanding. But then we later resold some of those shares of treasury stock. Right here, we sold 10,000 of them back. So the timeline of our common stock that was issued, we issued 50,000, we bought back 12,000, bringing us down to 38,000 outstanding, but then we sold 10,000 back, which means there's now 48,000 shares outstanding. And it means there's still 2,000 shares in our treasury. When we pay dividends, we're not going to pay it on the total amount of shares that we issued. We only pay it to the amount of those shares that are in the hands of the public. So we just figured out that was 48,000. If we multiply that by 50 cents, we find out that we are going to owe $24,000 worth of dividends to our shareholders at the time. Our second credit is going to be to our dividends payable preferred account. And for dividends payable preferred, we need to figure out how many shares of preferred stock are outstanding, which is much easier than what we just did because we haven't repurchased any shares of preferred. We have only issued the shares right in the beginning of the year, and we've not bought any back. We don't have a treasury stock preferred account, which means all of the shares that we issued are still in the hands of our shareholders, which means we still have to actually pay for every share. So if we scroll way up to the beginning, we see that on January 3rd, we issued 5,000 shares, and when we issued it, the par was $50, and their preferred stock was 6%. That's the rate of dividend payment that we're going to make based upon the stock's par amount. So when we come down here to our entry, how much is it going to be for? It's going to be for the number of shares outstanding, which is 5,000, times our par price of $50 times the rate that our dividends pay interest, which is 6%. Again, that would be for a whole year, but since this is a semi-annual payment, we need to divide all of that by 2. So your formula should look like that. And when we multiply that out, we come up with 7,500, which means that the amount that we have to put into cash dividends is equal to the amount of dividends payable we just declared for common shareholders plus the amount that we declared for preferred shareholders, which is going to be a total of $31,500. In our description, we declared dividends. The last entry that we have in here is on December 31st, and it is us closing our cash dividends to our retained earnings account. At the end of every period, you have to close your cash dividends. This is a temporary account to retain earnings because you have to pay dividends out of your own internally generated profits or your retained earnings. This is actually a closing entry, so you would do this after you made all of your financials for the period. You made all of your T's, etc., which is what I'm going to ask you to do next. So for right now, you actually can't fill in the numbers, but what we can do is we can set it up, because it's always the same entry over and over and over again. It is going to be a debit to retained earnings and a credit to cash dividends. And in the description, you can say that you are going to close your cash dividends. In the next video, I'm going to do all the T's and financials, and we'll come up with that number, and I'll come back here and finish this journal entry. So let's move on to the next video.